I'm John Hanna for CityTV.net in New York, and we have Dirk Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Hey, Dirk, how you doing?
Well, I'm doing okay. I finally got some nice weather out here, so everything seems to be quite nice.
Same here, same here. So, Dirk, what do you have for us today?
Well, the big news last week was, of course, the employment report, and it was, kind of a mixed picture. You got to remember that the employment report is composed of two separate surveys, the establishment survey and the household survey. The establishment survey is one that most people look at in terms of the number of jobs that are created or lost each month, and the household survey is the one from which unemployment rate is derived. And the two surveys were sort of moving in opposite directions this month. And while that's certainly not unprecedented, it is a little bit unusual. The establishment survey came in much better than expected. We created a total of 244,000 new jobs. That includes 268,000 from the private sector, and offset by a loss of 24,000 government jobs, mostly at the state and local level. About 2,000 of those were lost at the federal level. And it's been sort of a recurring pattern where we've been losing a lot of jobs in government due to the budget cuts, while the private sector has been adding jobs. In addition, we also got some upward revisions to the previous month's numbers. Last month, in March, we actually gained 221,000 jobs, not the 216 originally posted. The report came out last month, and the February report was revised up for a second time, and this time to 235,000 jobs, and it was last month reported at 194. So you take the combination of the upward revisions plus the better-than-expected totals, again, 244 when the expectations were for 185, that's a pretty solid job result. And the jobs were really widespread. We got 44,000 of them, the goods-producing sector, including 29,000 in manufacturing. The service sector was really going great guns, adding 224,000 jobs in the month. So, again, on the establishment survey, a very solid report. Now, the household survey had, up until this month, been much more optimistic, if you will, than the establishment report. It was reporting much bigger gains in employment. But since it's a smaller survey, most economists don't focus on the number of gains or losses in the household survey. Where it is important is the unemployment rate, which is probably the single most followed number as far as the general public is concerned. There, the news wasn't quite as good. The unemployment rate rose to 9.0 from 8.8, but that's sort of a reversal from a very sharp downward trend that we had. A year ago, it was 9.8%, and as recently as last November, it was 9.8%. So we had been making very sharp progress on it. Now, one thing that the jump in the unemployment rate was not due to is for more people going out and looking for jobs. This is something that half the press reports just flat got wrong. I mean, over and over you've seen people say, oh, it was just because more people were looking for jobs. That is not true, and there are an awful lot of journalists out there who are basically incompetent for making that statement. If that were the case, the civilian participation rate would have gone up. That was not the case. It was at 64.2%, the same number it's been since January, and that's down actually from 65.1% a year ago. And that actually explains an awful lot of the drop in the unemployment rate, is that fewer people looking for work, at least relative to a year ago, and really an unchanged number since the start of the year. The actual percentage of Americans who are employed actually ticked down slightly to 58.4% from 58.5%. Now, that's a number that's never going to get anywhere close to 100%. The highest it's ever been has been, I think, 64.7%. That was in April of 2000. I mean, for that to get up to close to 100%, you wouldn't be raising the Social Security retirement age to 67. You'd be raising it to 167. So, I mean, it's just not going to happen, and there would be no such thing as a stay-at-home mom or a stay-at-home dad to get up to anything like those sorts of numbers. So the difference between the unemployment rate, which was going up, and the employment, the number of people being employed, is entirely a function of two different surveys being used. And as I said, for the first, at least 3 months of the year, and actually going back into 2010, we've been consistently seeing better results on the household survey than on the establishment survey, and that sort of reversed a bit this month. Over say the last 6 months, we're just sort of bringing those two figures back into closer alignment. But in terms of the unemployment rate, the news was kind of bad, really across all the various demographic groups that you can look at. The unemployment rate for men rose to 8.8% from 8.6%. From women, to 7.9% from 7.7%. For teenagers, both sexes, to 24.9% from 24.5%. Those are all really kind of ugly trends. I would point out that this recession has been much harder on men than it has been on women. There are two possible explanations for that, not exactly mutually exclusive. The primary reason is the mix of jobs. The recession has been particularly hard on male-dominated industries, most notably construction. Construction is responsible for over a quarter of the job losses since the beginning of the recession. Actually, given the gains that we've seen elsewhere in the economy, it's now up to 30% of the total jobs losses. That's a highly male-dominated field. You just don't see a lot of women framers and roofers and plumbers. I mean, they're out there, but they're in a rather distinct minority. On the other hand, the healthcare field, which has got a lot of women, doctors, nurses, orderlies, etc., is the one industry that has gained jobs every month throughout the entire recession. And So that difference explains a lot of the reason why the unemployment rate is so much higher for men than for women. The other reason is that, by and large, in this country, men get paid more than women, and it may just be that employers are sort of waking up and saying, if I've got two people to lay off, I might as well lay off the more expensive one. Although a lot of that, the advertised difference between, the women earning 78% of what men do, really has to do, again, with more the mix of jobs that women tend to take as opposed to men. So on a same job basis, there is a difference, but it's much more narrow than the widely publicized number. Again, getting back to the demographics, whites, the unemployment rate ticked up to 8.0 from 7.9. Blacks really took it on the chin, with the unemployment rate rising to 16.1% from 15.5. Hispanics saw their unemployment rate go up to 11.8 from 11.3. Now, I do have to point out that, while the trend moved against each of these groups in the month relative to a year ago, the unemployment rates are down basically. I mean, we still have a very, very long way to go. I mean, unemployment still remains the biggest economic problem we have in this country, even if nobody in Washington, D.C. Seems prepared to do anything about it and seem to, be focused on lesser problems and treating them as if they're absolutely urgent and have to be addressed right now, even if they, are going to make the unemployment situation worse. First and foremost of that is this obsession with the near-term budget deficit, and the second, which is preventing anything on the fiscal policy side to stimulate job creation. And then on the monetary policy front, things are even more bizarre. I mean, here we are with core inflation at the lowest levels in decades, and headline inflation on a year-over-year basis lower than it's been in two-thirds of the months since 1960. Yet that is now the obsession. When Bernanke held his press conference, that was all that anybody wanted to ask him about was inflation, inflation, inflation. I don't know if people saw that word map of the number of times he used various words, but it's massive, 128-point type for inflation, and everything else is like a 10-point type. That's just irrational. Over the short term, particularly, there is a trade-off between inflation and unemployment. If the unemployment is too high, then the correct policy response is to have a more accommodative or easier monetary policy. Now, with interest rates at zero, that sort of cuts off your normal channel for doing that, and so you have to resort to something like QE2. That policy is about done. By June, it's going to be completed, and it really looks like there's no real prospect for QE3 happening, and all the talk is about how are they going to unwind this, despite extremely low levels of inflation and very, very high levels of unemployment. It's just sort of backwards. And I, for the life of me, I watch the Sunday morning TV shows, and it just really isn't a topic where anybody's going to do anything about it. They might wring their hands and they say, oh, this is all structural. No, nonsense. This is because we don't have enough demand in the economy as people are trying to pay down their debts and save more and de-lever because they've lost so much money in, their housing equity, amongst other things, and, they were planning on using that money for something. Probably being able to retire or to send their kids to college, and presumably people still want to retire and send their kids to college, but they don't have that housing equity that they were planning to use, so they got to save more and pay down their debts. And as you do that, it slows the economy. And, normally you use fiscal policy. You deliberately run a deficit during a recession or early in the recovery to try and stimulate. Some of that happens automatically in that tax collections tend to fall, because people have less income, hence less income taxes. And, some of it happens automatically through things like unemployment benefits, which spending tends to go up when that happens. But when you get a deep recession, fiscal stimulus is very much called for, but appears to be off the table. And the discussion in Washington is all about how can we get into more austerity and trying to drive up, well, it's not trying to, but the inevitable result of that is going to be higher levels of unemployment, or at least a slower decline in unemployment. And, the number of people who have been out of work for, a very long time, over 6 months, while we had some improvement in that, you still have 5.8 million people who have been unemployed for more than 6 months. That's 43.4% of all the unemployed. And that's a very different thing than the being out of work for 3 or 4 weeks. That's kind of like an unscheduled vacation. When you've been out of work for months and months, and a lot of people have been now out of work for over a year, your contacts dry up, your skills start to atrophy, and you actually become less employable over time. And in the meantime, no income and unemployment benefits not really covering people's fixed expenses. People tend to go deeper into debt. They draw down their savings, and it affects their financial well-being not just now, but really for the rest of their lifetimes. They have to tap their 401ks. But you would think that at 9% unemployment, that would be the chief topic of conversation in Washington, D.C., at least on the domestic policy front. But everything seems to be going in the other direction. Now, I mean, we have had some nice job growth, over the last year. The decline in the unemployment rate, while partially bolstered by fewer people looking for work, we've also been, starting to create jobs at a pretty reasonable pace. If there were normal times, this would be fine job growth. I mean, the 268,000 private sector jobs that we created this month is higher than the average that we saw during the Clinton era expansion. The problem was that during 1997, 98, 99, it wasn't like we were trying to make up millions and millions of jobs that had previously been lost. And so when we're trying to climb out of this deep hole, 268 private sector jobs, while nice, really isn't going to do the trick. I mean, it's going to be a long time, like well into 2014 at this pace, before we get back to the total number of jobs we had in the economy at the end of 2007 when this recession started. Meantime, the population continues to grow, and it really is the major problem that we have in the economy. We're just not growing fast enough to generate the jobs that we need to get out of this deep hole.
That's Dirk Van Dyke, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. And I'm John Hanna for CDTV.net in New York.